The Federal Reserve has paused its interest rate hikes. After a series of aggressive moves to combat inflation, the central bank is taking a breather. This decision marks a significant shift in monetary policy, leaving investors and economists alike wondering what comes next. Sounds like a reason to celebrate, right? The initial reaction might be one of relief, especially after months of uncertainty and market volatility. But before you start popping champagne, hold on a second. Remember, a Fed pause isn't always a green light for a bull market. In fact, history suggests that a pause can be a deceptive signal. Sometimes it's a warning that trouble's ahead. It's crucial to understand the underlying reasons behind the Fed's decision. The Fed pauses because they see risks. Maybe the economy's cooling off too much. Are they concerned about a potential slowdown in growth or even a recession? For investors, this is a crossroads. It's a moment that demands careful consideration and strategic planning. Is the pause a sign of victory over inflation? A signal that the Fed has successfully navigated the economic storm? Or a signal that a recession is looming? Are we simply delaying the inevitable? Or have we truly turned a corner? Growth stocks love cheap money, as lower interest rates can fuel their expansion and profitability. But a weakening economy could spell trouble for everyone. Even the most promising companies can struggle in a downturn. The real question? Is the Fed pausing from strength or fear? Are they confident that inflation is under control? Or are they worried about the potential for a severe economic contraction? Your next move depends on understanding why the pause happened. Dig into the data, analyze the Fed's statements, and consider the broader economic context. This decision could define your portfolio for the rest of the year. It's a pivotal moment that requires careful planning and a well-defined investment strategy. Let's break down what to watch for. We'll examine key economic indicators, analyze market trends, and explore potential investment opportunities. Because in this market, where volatility reigns supreme, the difference between a rally and a crash is razor thin. Staying informed and making smart decisions is more critical than ever. The Fed. It's a name you hear all the time in financial news, but what does it really? Well, think of the Fed as the economy's thermostat. It's constantly monitoring the temperature, making adjustments to keep things running smoothly. When inflation is running too hot, the Fed steps in, raising interest rates to cool things down. This makes borrowing more expensive, which in turn slows down spending and brings inflation back under control. Conversely, when the economy needs a boost, the Fed lowers rates to heat things up, encouraging borrowing and investment. It's a delicate balancing act. After a period of aggressive rate hikes designed to combat rising inflation, the Fed has now decided to pause. This is a significant shift in strategy. They're holding interest rates steady, taking a moment to assess the impact of their previous actions, and to see if their medicine is indeed working to bring inflation down to their target level. It's a wait-and-see approach. They're not cutting rates, signaling that the fight against inflation isn't over yet. And they're not hiking them either, acknowledging the potential risks to economic growth. Instead, they're meticulously watching the incoming economic data, analyzing every report and statistic for clues about the future direction of the economy. This pause is a pivotal moment for the economy and for investors alike. It represents a turning point, a moment of uncertainty where the future is far from clear. The big question is, are we heading for a period of sustained stability, with inflation under control and the economy growing at a healthy pace? Or is more turbulence ahead with the risk of recession looming large? The Fed's closely watching jobs data, paying particular attention to the unemployment rate and the pace of job creation. They're also scrutinizing inflation and consumer spending data, looking for signs that price pressures are continuing to ease and that consumers are still willing to open their wallets. Ultimately, the Fed is waiting for definitive proof that inflation is truly under control and that it's on a sustainable path back to its 2% target. The market, as always, hates uncertainty. Investors crave clarity and predictability, and a Fed pause introduces a significant dose of ambiguity, and a pause, by its very nature, is full of it. It leaves investors guessing about the Fed's next move and the future direction of interest rates. Is this just a temporary pit stop before the Fed resumes its hiking cycle, pushing interest rates even higher? Or is it the beginning of the end of the rate hiking campaign, paving the way for eventual rate cuts down the road? That's the central mystery that's currently gripping Wall Street and Main Street alike. And it's precisely why markets tend to get so jumpy and volatile whenever the Fed signals a change in its policy stance. For now, the Fed's foot is off the gas pedal, taking a breather after a period of aggressive tightening. But they're also making it clear that they're ready to slam on the brakes or hit the accelerator again at a moment's notice, depending on what the economic data tells them. For investors, this is a time to pay very close attention to the economic tea leaves and to carefully consider the potential implications of the Fed's next move. Because the Fed's next move, whether it's another rate hike, a rate cut, or simply maintaining the status quo, could very well change everything. So, let's keep a close eye on the market and see how Wall Street is reacting to this delicate balancing act. The coming weeks and months will be crucial in determining the ultimate outcome. When the Fed pauses, Wall Street splits. Bulls cheer, bears worry. Bulls see a soft landing. Rate hikes are done, growth can resume, and stocks could soar. They point to history. Markets often rally after the last hike. Bears, though, see danger. The Fed pauses when it senses trouble. They fear the economy's about to stumble, with earnings and jobs at risk. For bears, the pause is just the calm before the storm. Bulls buy growth stocks, betting on a rally. Bears shift to safe havens, bracing for a downturn. The market's next move depends on who's right. Are we celebrating too soon, or is pain still ahead? Let's look at how stocks and bonds are reacting. The Fed's pause sends shockwaves through stocks and bonds. Stocks often rally at first, especially tech names hurt by rising rates. But the real test comes after. If economic data stays strong, the rally can last. Weak data? The party ends fast, and stocks tumble. Bonds tell another story. If traders expect a recession, they buy long-term bonds, pushing yields down. Falling yields signal fear about growth. If inflation's the worry, traders sell bonds and yields spike. Watch for divergence. If stocks rise but bond yields fall, the market's sending mixed signals. That's a red flag. Stocks may be too optimistic. The smartest investors watch both markets for clues. The story they tell together is what matters. So what's the Fed watching to decide its next move? Let's dig in. The Fed's eyes are glued to a few key indicators. First, inflation. They want to see a steady drop toward their 2% target. Not just one good report, but a trend. Second, jobs. A cooling labor market is fine, but a spike in unemployment is a red flag. Third, global trade and tariffs. New tariffs can fuel inflation and slow growth, complicating the Fed's job. Finally, sentiment. Are consumers and businesses confident or getting nervous? Surveys and business indexes offer early warnings. The Fed pieces all this together before making its next move. For investors, tracking these same numbers is crucial. The data will tell you if the pause leads to cuts or more pain. Stay alert to these signals. Next, let's decode the Fed's secret map, the dot plot. Want to know what the Fed might do next? Check the dot plot. Each Fed member marks where they think rates should be in the future. The median dot is the market's best guess for the Fed's path. After a pause, the dot plot is critical. Are more hikes coming, or are cuts on the table? But remember, it's just a forecast. Data can shift the dots quickly. That's why markets react so sharply to new reports. A hot jobs number, dots move higher, rate cuts get delayed, weak data, dots drop, cuts come sooner. The dot plot is the Fed's scoreboard, and every new data point is a game changer. Investors are always trying to stay one step ahead. The Fed is walking a tightrope fight inflation without causing a recession. Cut rates too soon, and inflation could roar back. Keep rates high too long, and growth could stall, jobs could vanish. Their tools are blunt, and the effects take time. The pause is a high-stakes waiting game. External shocks, like trade wars, make the job even harder. Every decision is a balancing act. As investors, we're watching the Fed's every move on this wire. One misstep, and the whole market could wobble. The Federal Reserve has signaled a potential pause in its interest rate hikes. But what does this really mean for your investments and your overall financial well-being? It's a question on everyone's mind, and understanding the implications is crucial for navigating the months ahead. So, what does a Fed pause mean for your money? It's not a green light, it's a yellow one. Think of it as a period of assessment, a time to proceed with caution rather than full speed ahead. The economic road ahead is still uncertain, and this pause doesn't guarantee a smooth ride. The aggressive rate hikes we've seen may be coming to an end, and the immediate pain from those increases may be behind us, but uncertainty is still high. The market is still digesting the effects of those hikes, and the future direction of the economy remains unclear. This is a time for caution, not reckless buying. Don't let the potential for a pause lull you into a false sense of security. Now is the time to carefully evaluate your risk tolerance and make informed decisions. If the soft landing happens, meaning the Fed manages to curb inflation without triggering a recession, growth stocks, particularly in sectors like technology, could shine. These stocks tend to be more sensitive to economic growth, and a stable economy could fuel their rise. But if recession hits, and the economy takes a downturn, defensive stocks and bonds are generally safer bets. These assets tend to hold their value better during economic contractions, providing a cushion against market volatility. Don't go all in on one outcome, stay diversified. A well-balanced portfolio spread across different asset classes is your best defense against an uncertain future. Diversification helps to mitigate risk and ensures that you're not overly exposed to any single market movement. Watch the data, pay close attention to key economic indicators like inflation, unemployment, and GDP growth. These data points will provide valuable insights into the health of the economy and the likely path of interest rates. Listen to company earnings, as they offer a glimpse into the performance of individual businesses and the overall corporate sector. Strong earnings can signal resilience, while weak earnings may indicate underlying economic challenges. And pay attention to the bond market. Bond yields can be a leading indicator of economic activity, reflecting investor expectations for future growth and inflation. The Fed is trying to pull off a rare feat, a delicate balancing act that has proven difficult to achieve in the past: beat inflation without a recession. It's a challenging task, requiring precise calibration of monetary policy and a bit of luck. Maybe they'll succeed, maybe not. The outcome is far from certain, and the economic landscape could shift quickly. But hope isn't a strategy. Relying solely on optimism is not a sound approach to investing. Use this pause to reassess and prepare. Take advantage of this period of relative calm to review your portfolio, adjust your asset allocation, and ensure that your investments align with your long-term goals. The market's given you a breather, use it wisely. Don't waste this opportunity to strengthen your financial foundation and position yourself for future success. Are you a bull or a bear on this pause? What's your outlook on the market's reaction to this potential shift in monetary policy? Let me know in the comments. I'm eager to hear your thoughts and perspectives on this important topic. There's money to be made, but only if you stay sharp, informed, and disciplined in your investment approach. The market rewards those who are prepared and proactive.